Selling your business, what you need to know. Brought to you by Bull Realty, Asset and Occupancy Solutions. The Commercial Real Estate Show. An AKB Media Partners production. This video nor its participants are providing professional or fiduciary advice. For recommendations to professional providers, visit AtlantaLeadersGroup.com.
All right, welcome to Atlanta Leaders Group. We have a great panel today. Our discussion is going to be selling your business, what you need to know. And we've got four experts. I'm going to ask them to first start off with a 30-second intro so you know who's talking here today. First of all, I'm Michael Bull. I'm with Bull Realty, based in Atlanta, licensed in 10 states. We help companies with their space, selling their buildings, buying buildings, and leasing space. And I'm host of the Commercial Real Estate Show, a nationally syndicated show about commercial real estate. And if you guys could give us a 30-second on your company and your services.
My name's Dennis Melde. My company is Fiducia, LLC. We specialize with businesses between $10 and $200 million in that area to help them with all sorts of different areas, mostly exit planning, the buy-sell agreements, the family planning for their family, wealth preservation, and just generally ways for them to move the business that they have created on, and then also with what they have to do afterwards to be able to reach their financial goals.
I'm Mike Bloom. I lead Piedmont M&A Advisors. We are investment bankers that help companies between $10 and $200 million in revenues either purchase a business, sell a business, and or finance that business. Our companies are privately held and typically entrepreneurially led, and they cross a wide variety of industries throughout the U.S.
Okay.
I'm Kevin Loechl. I'm with the law firm Bird, Loechl, Britton & McCants. We're based in Atlanta, and we work with privately held businesses as well as nonprofit organizations in helping them through transactional issues, corporate law issues, estate and business succession planning issues, litigation, intellectual property, and the nonprofit tax issues area as well. And my practice focuses heavily on mergers and acquisitions as well as commercial agreements and other various areas of corporate law.
Jeff Olson, I'm a partner with the CPA firm Babish, Neiman, Corman & Johnson. We're an Atlanta-based CPA firm. We've been in business here for 53 years. Full-service CPA firm focused on middle market companies and the individuals and families that own them.
All right, to get us started, I've got to get a comment from each of you. I think one thing is when you're going to sell a business, you want to start thinking about it well in advance, maybe when you're starting the company, right, to run it so that one day you think you're going to sell it. So, Mike, if you could start us out, what should people think about if they think they're going to be selling their business down the road in a few years?
Think about what the purchaser would like to see in your business when you get ready to sell. And you want to match not only that, but cultures, the way they do business and the way your firm does business.
Okay.
I think there's really things that everyone has to realize. It's pretty basic. The ways to pass the business on are really basically only four ways. You have a third party, possibly. You pass it on to your family members that are in the business, or you have key employees, or you plan liquidation of the business. The key that I've always seen is what we have to do is get our owners, find out what their financial goals are for the future, how they want to retire, how much money they need, so we can work backwards from there, so we can find out exactly how much capital that they need to accumulate for them to have a great rest of their lives after they get out of their business.
Sounds fun.
I think a key area from a legal perspective is to get yourself organized. Do a little bit of an internal audit of legal issues, accounting issues, and other risk issues that can yield a lot of benefits by simply, it prepares you for the due diligence process, but it also helps you identify key risk areas that you should address ahead of going into a selling mode. so that you can give your buyer confidence and enhance the chance that you're going to get a really good purchase price and receive full payment of it in the transaction.
I wanted to add, Mike, to what you had to say about having put together what the buyer wants to see. I fully agree with that concept. But I think you also want to think about, given your business, the industry it's in and its size, think about who that buyer might be. Is it going to be a strategic buyer, a financial buyer, an inside sale to the management team? Is it likely to be purchased by a wealthy individual, or is it likely to be purchased by a private equity group? Each of those different constituents may have different things that are important to them, so I think you kind of want to think of, given the business, who is the most likely buyer type out there?
And that rolls well into my next question. I think every seller of everything wants to know how to get top dollar, right? So what are some tips for doing that? As you're operating your business, you're setting an as you're getting ready to sell down the road, what are a couple tips for maybe getting more for the business?
Well, Mike, I think that if an owner needs to understand, and they probably built this business up from nothing, or maybe they bought it from someone, but most of the time they built it from nothing. And that means that they're very integrated into the business itself. What we try and do is talk to our owners and say, I want you to disintegrate yourself from the business. I want you to be the least important person here. Because the lower the amount of emphasis that there is on the owner and him bringing in the business and him being central to the business, the higher the value of the company will be, because then when he's gone, the whole business can still thrive.
Yeah, if you can't go on vacation, you're in trouble, right?
Yeah, we always tell them that if they should be able to take 2-week vacations without missing a beat, and at least 4 of those a year.
I'm just signing up for that.
Yeah.
Mike, another tip to maximize value when selling?
I tell clients that I think they ought to have a very good grasp of what the industry's dynamics are from a financial standpoint. In other words, if you want to maximize your value, be sure that your profitability is at or above the industry average for your own industry. You'd like to be growing profits at the same or better rate than the rest of the industry is, and you'd like for your revenue growth to be growing similarly. If you have to choose one over the other, choose profit.
And that's interesting. I think some of us, when we run a business that's closely held, like I own a business closely held, and I'll invest a lot of money back in the business. So I think if I'm thinking about selling the next couple of years, I better watch that, right? Because now I'm eating them cash flow.
You want to be able to identify those things that perhaps the next owner will not have to do,
Okay.
as well as those that they will discover in the process that they're going to have to do right out of the chute.
Okay. And Kevin, what about on the legal side? If you've helped companies sell businesses or buy businesses, what hurts value, what helps it?
Well, again, I think a real key is to plan ahead and do that audit that I described earlier. That gives you an opportunity to identify assets that you have, maybe intellectual property or other things that you can monetize and generate an additional revenue stream to complement your core business that will drive up the overall value of the business. It may generate an asset that separately is more valuable than packaged together, so you have 2 things to sell. But the other thing is, without really knowing the types of risk that you have in your business, the weaknesses in your business, you end up in a weak negotiating position when the buyer comes in and discovers them and you haven't addressed those things. So that will tend to drive a lower offer price. It will also drive reductions mid-deal in the purchase price when the warts appear. Every business has some warts, so you don't have to have a perfect business. You just need to have a plan and show that you've addressed these things proactively so you're not unpleasantly surprised.
Yep. Kevin, I think having good processes, systems, and financial information. Any prospective buyer is going to assess the value of the business and whether or not they want to buy it and at what price based on financial information and how reliable is that information. As you said, if there's surprises along the way, Well, the information said this, but once we dug into it, we found something else. The way that I described it is having that part of the systems and information locked up, a good management team, as we said, so that it's not dependent just on the current owner. What you're really doing is putting something in place that a buyer will perceive less potential volatility. We're not dependent on the current owner. There's systems, processes, and management depth that the business can continue to run. Less volatility means less risk, and therefore hopefully a higher value at the end of the day.
Okay.
One other thing that I think is important, because this has actually happened to me, diversification of your customer base is really important. I had one company, just for example, real quick, that had 80% of their revenue coming from one client. And guess what happened when that one client went away? It's really hard to take an 80% cut in revenue. So we always take a look at the diversification of the customer base to make, and our goal is to keep none of the revenue, make it at 10%. 10% of the revenue comes from more than one source.
Yeah, that's a good point. Now we're going to go over some of this, the rest of this. We're going to go a lot quicker to get to a lot of information. So we're not going to be able to go really deep. But if you're here at ALG today, they'll be here after the meeting to talk with you. We'll also have in ALG time some Q&A. If you're watching this on video, the contact information for all the speakers will be below the video, so feel free to reach out to them for more information. And Mike, as an M&A guy, I'm sure you've seen people do things right and make some mistakes, and people like to know, hey, what are the top 1, 2, or 3, say, mistakes that we should absolutely try to avoid?
I think one of the mistakes that I see most often is where people try to do it themselves. They do not get a disinterested third party to help quarterback the process. And I think that's key, because we need each of the skill sets that are around this table today. So I would say that is right at the top. The other is thinking that you can overcome culture. You really want to be sure that the culture of the people to whom you're selling, as close as possible, matches your own. In fact, I've had clients tell me when they were purchasing, they did not want the company being acquired to rule the roost after they had been purchased. They wanted their own culture to continue.
What would be the dream team if you were selling your business to have on the team?
Go further with your question.
Would you want all 4 of these kind of groups of people if you're going to sell a business? What kind of outside folks should you bring in to help you with the process?
I think you ought to bring in a person like each of these, and I think your wealth manager, if it's not covered by Dennis, needs to be a part of it. Because on the very front end, we want to set a value on this, and that may mean an outside expert, it may mean us, but that value goes right down to finding out, can you live the way you want to live after this business has changed hands?
And one of the mistakes that I see that a lot of business owners make is they reinvest, and it's not unusual for them to reinvest money back into their business and back into their business. It's really important for them to create capital outside of their business on a tax-favored basis. You can do that through qualified retirement programs like profit-sharing plans and those kinds of things. Because the larger the amount of capital that we can have outside of the business, the more flexibility we have on price when we get down to selling the business, when Mike's getting ready to sell it.
Okay, and I have another question I think that a lot of business owners have, and that is confidentiality. I mean, if I'm selling my business, now I've got to kind of pull up the curtain, right, and show my competitor maybe, the details of my business. So how can you make a business seller more comfortable with that? Mike, you want to start out?
The first thing we do is when we are providing a potential buyer's list for the company that you are selling, most sellers are going to rule out certain potential buyers. They will not want to come within a 10-foot pole for sake of discussion, of having discussions and exposing their business and what's going on. Secondly, we have each potential purchaser sign a confidentiality agreement, and we rarely find that people want to test that. But the third thing I will say is that there are slips, and it's possible for you to get a call and say, I understand you're in the market with your business. It won't come from your investment banker, but it can come from loose lips in the trade.
Do business owners maybe think too much of that process? Should they be conscious of that? Are they too afraid of that? Should they not worry about that much? Or should they be aware?
Business owners should honor a confidentiality.
But as a seller, are you putting too much thought in it? Or should not worry about it, Kevin, or people? You're gonna protect us, right?
I'll do my best. I think a good non-disclosure agreement can go a long way. It's a relatively simple thing to do. They're usually about a page or two long, but they can mean a world of difference in dealing with a potential buyer that you may be exposing confidential information to. But there's a couple other things that I think should be kept in mind. One is you need to also make sure that internally the existence of the deal, the possibility of the deal, is that knowledge is limited to the key group of employees who are going to be helping with the deal and may be expected to continue running the business after the transaction. And that's a tricky path to follow. There are a number of steps that you can do, but loose lips and nervous employees can really damage a deal or be a huge distraction from the operations of the company at a time when you're trying to maximize the value of the company.
Any more tips on that situation with your key personnel and your employees of how to handle those people?
Yes, a couple things. I mean, one is I think you want to identify early those key people who you're going to need either to help you with the deal or run the company after the transaction, and get them involved, bring them into over the wall, as we say, early on. And then internally, you'll want to make sure that you develop some communications tools to facilitate the due diligence as well as internal discussion about the deal. So maybe you need to have a different email address or have a couple of code words for the transaction or and meet off-site. On the other hand, you don't want to create this air of mystery that gets other employees asking questions and wondering what's up. And then I think the other key things are, with respect to those key employees, you're going to be needing to negotiate with the buyer employment agreements for those key people who, especially if you're going to have an earn-out, you're going to need key people in place who have the ability to run the business successfully. And I think you should plan for some bonuses for those who worked very hard through the transaction to make it a success, as well as severance packages for key people who will not be staying on. Because you still need them to be invested through the closing to make it a success.
And they got you to where you are. They're giving you the opportunity to do this.
That's right.
Michael, on the question of confidentiality, I think certainly the confidentiality agreement is the bedrock. I had a client that sold June before last, and they were selling to a competitor. In fact, this competitor had talked with them 2 or 3 years before. My client wasn't ready to sell yet. But one of the things that we did is we said, look, we'll give you all the information you need, but we're not going to give you the customer list until the week before we close.
Yeah,
to hold that back in that type of a situation where it was a competitor firm.
That's a great idea. And you mentioned earnout. So what are some, how many businesses are sold maybe without an earn? If you're a seller, you probably would like to not have an earnout possibly, but maybe you do want to stay in the deal. So how many sellers of companies are in an earnout situation where they're not getting all their funds at closing, if you will? And then what's an example of an earnout that you've seen? Mike, you want to start us out?
I would say that perhaps 50% of the sellers I see have some type of earnout. Some days that earnout is a small percentage, but it's done so that the purchaser has 1 or 2 years to uncover anything that wasn't uncovered in due diligence. Some days the purchaser wants the seller, especially if that seller is key in business development, to stay involved in transitioning relationships. There, a large percentage of the purchase price is paid up front, but you can have a 3 to 5 year earnout, and that earnout can be based not only on the amount of sales that are generated by the company and this individual, but also the gross profit of those sales.
Okay. Let's talk about valuation. I think as a seller, you always want to know how to get that value up. And are there any rough ratios of EBITDA or other ways that some businesses have some basic values, Jeff?
I mean, a very, very general rule of thumb, and I can't stress enough how general this is without regard to industry or any specific company. I typically would tell someone who asks me, what's my company worth? I'd say 80% probability is between 4 and 6 times adjusted EBITDA. That being earnings before interest, depreciation, taxes, adjusted for any owner perks, let's say. Now, are there some that sell for more, some that sell for less? Certainly, but I think that's a good benchmark to use. I know Mike and his work with a bunch of different companies in many different industries can probably speak beyond just that general rule.
I would say Jeff's being conservative and really wise. When you're valuing a company, you're setting expectations. And that's why we do that up front. And we create what we call a range of value. We don't try to hit it in the crosshairs. It's how you stack up compared to your peers in the industry. Are you tracking at a better sales rate? Are you tracking at better profitability? Customer concentration can torpedo a valuation.
What do you mean by that?
I mean that if you have 80% of your business in 2 or 3 customers, let alone one, you can count on a substantial drop in valuation, 25%, 35%. There may be things to build in to help offset that risk, but that's a tremendous risk for a purchaser. And rarely do they see it coming. If you have a $25 million sales company and you have 5 clients that make up 75 or 80% of your business, 2 clients come to you and they say, we are each going to drop between $200,000 and $300,000 of your business per month. Well, you've just lost $6 million in a year in terms of revenue. And that might take you from being a very pretty company to consider purchasing to one that's right back at break even, especially if you're in the manufacturing business.
I want to circle back and touch on the earnout question in the context of valuation. And there's several different scenarios when an earnout would be used, where a business is a high-risk business or has a growth opportunity with an unproven product or something. But another context in which an earnout is used is to bridge a gap between the seller's expectation of value and purchase price and what the buyer thinks it's worth, with the buyer willing to pay a little bit more if it proves out along the lines that the seller expected. Earnouts are really tricky. They're the #1 source of litigation in M&A deals. So they have to be very carefully negotiated, and those earnout formulas can be very complicated. So it's something you want to pay a lot of attention to.
Kevin, on that basis, I think Mike mentioned that maybe half of the M&A deals involve an earnout of some type.
Yeah.
Of those half, what proportion of those ultimately end up in litigation, would you guess?
You know, I would say maybe a third.
A third of that half.
Yeah.
Okay.
And earn-out litigation can be long and ugly.
You know, I don't like that answer. I'll do the questions, Jeff. I want to get back to valuations for a moment and touch on this. What about goodwill, right? So is there any value, and how do you value? We hear that there's value for goodwill, there's value maybe for your website traffic and how it rates, and what about if you have a huge social media following? How is that ascertained?
I'll take a quick stab at it. I mean, the goodwill value is what we really call just the going concern value of the business. You know, it takes a collection of assets for a business to run. I can go out and buy those assets, but if you've got the business already up and going and making money, well, I'm willing to pay a little bit more because I have less risk doing that. So from an accounting standpoint, the goodwill value is merely, I'm willing to pay you $10 for a collection of assets that I could go out and buy and replace, say, for only $6. I'm willing to pay $4 more, or the goodwill value for the going concern. And Michael, on the social media aspects, I think it's highly dependent upon how dependent is your business on that social media aspect. Being a CPA firm, ours would not rank extremely high. We need to have some presence, but we're not
tweet all the time.
We're not a consumer-based oriented type firm. So for us, it wouldn't be as high, but for others, it could be extremely high. So those intellectual properties, be it websites and everything else, can add to value as well.
Okay. Quick question on a sample time frame. So I've decided to sell my business, Mike. How much time is this going to take, this whole process?
I would count on a minimum of a year. We go into it trying to do it much quicker than that, but I've seen what just appeared to be beautiful businesses, were beautiful businesses, but we were selling in a very difficult environment. And by beautiful, I mean double-digit earnings before interest, taxes, and depreciation, and product that was just outstanding. But there are days that it just takes a while to do it. So be prepared for a minimum of a year. Some people may tell you 6 to 9 months, but I don't want to set that expectation. Are we going to try to make it happen fast? Yes. We're going to be talking to people that are potential buyers? Yes. It also depends upon who you let us go to as a potential purchaser. If we give you a potential buyer's list and you whack 50% of that list because you're angry at somebody and doesn't really have any logic to do with it, you've really dampened our chances of being able to lead you to a successful sale.
Okay.
You know, I agree with Mike 100%. It's just, there is one rule of thumb that we always try to go by. The longer you can give us, the better it is, especially when it's going to be employees buying out the owner. In a third-party situation, I mean, Mike's exactly right. But you may have to groom employees and get them ready and get them into the ownership mentality so they become entrepreneurs and they have that entrepreneurial spirit and will follow through whenever the time comes for that liquidity transaction to go through.
How much time would you like to have ahead of the time the business is going on the market to help us get our business ready?
To get it prepared.
And the tax implications ready. And it's like you were telling me, it's not what you get, it's what you keep, right?
Oh yeah, well the tax implications can get really crazy, because if you really think about how revenue comes into a company, and let's just say it's an S corporation, so you're going to be taxed at personal rates. The personal rate right now is 39.6%, plus Georgia State is 6%. So you add those together, it's about 45%. If you're selling a $10 million, and it would never go this way, if you're selling a $10 million business, you're going to get all $10 million in one big lump sum, which never happens. But if it did, that company, to pay you that, has to generate over $18 million in revenue to be able to pay out $10 million. And then you have to pay capital gains and some income tax on that payment that comes to you. So it comes out sometimes, it can, and this is the reason Jeff is so important when it comes to these kinds of things, him and his firm, because you look at the model and you can see that you can end up after tax paying more than the sales price when you add the taxes in.
Nice.
Over the $10 million sales price because of the taxes that are paid. But that's the reason Jeff's so important in these
And
transactions.
it's a big subject. We could talk a day on that, but Jeff, and I know it's dependent on the owners of the business and the business, but give us a few tips to help us out.
Glad to. I mean, the key takeaways, I think, if you're looking to sell a business, one, as we've said, have an idea of what you think the business is worth. If you've built some wealth outside the business, maybe you don't have to get the last dollar of what you think value is for the business. You might have a little more flexibility. But whatever that number is, also know going in, how much am I going to have left over after taxes? This one client of ours that sold last June, at the very outset, that's the first thing we did for the family that owned it. We looked at it in terms of a stock sale and an asset sale. What was the resulting tax bite, and what were they left with afterwards? So that would be number one. Have an idea of what the taxes are going to be. Within the context then of that sale price, talk to the buyer early about how you're going to allocate that purchase price if it's an asset sale. There's different implications in terms of type of gain and rate, whether it's ordinary income or capital gain, as to what rate of tax might apply there. That's a key one. Things that can be done in a transaction if you're comfortable, if you want to spread the tax liability out, maybe you take part of the purchase price back as a note and have an installment sale. So you're only taxed on the gains as the principal on that note is received. If you don't think there's a lot of credit risk, that might be one way just to spread the gain out. And if you have a business that also occupies real estate and you might own the real estate, keep in mind you can sell the business and retain the real estate. There might be a lot of gain in the real estate, and if the buyer doesn't necessarily need or want that, don't think necessarily of selling the whole or those two pieces together. You can sell the business and be taxed on that gain, but if you've got appreciation in the real estate, there's no need you have to trigger that gain in tax. You can continue to own that property, lease it to the buyer, and collect a rental stream thereafter. So that would be one more way to look at it as well.
Yeah, and that idea, we sell commercial real estate, and one thing that we've found is a lot of times it's good to sell the real estate first, do a long-term sale leaseback, so you're controlling the real estate for long term, because you think about the EBITDAs, the multiples we just spoke about, those are 20-25% returns on these business. Well, we could probably sell your real estate at a 6% or 7 or 8 or 9, depending on the property and the tenant string. Returns. So you're going to get a lot more in a lot of cases if you sell them separately and separate the tax years. Jeff, you mentioned selling the entity versus selling the assets of the entity. Which do you see most? What do you recommend?
It's a blend, and as Kevin can chime in, part of it's from a legal standpoint. Most buyers don't want to buy the entity, because when you buy the entity, you not only get the assets and contracts, but you get all the ugly warts in its background and history. So more often, a buyer wants to buy assets, and a buyer wants to buy the assets, the seller would rather sell the entity or the equity ownership, because it's all capital gain in that regard. But Kevin, in terms of the legal side, I mean, I've seen some where it had to be a sale of the business because there were some contract rights that weren't transferable. But outside of that, you have that push-pull between what a buyer wants and what a seller wants.
Right, I agree. A buyer will almost always want to purchase assets because, as Jeff mentioned, they can kind of limit the liabilities that they decide to assume. Whereas if you're buying the stock, you're getting the whole bucket and whatever's in it. Another reason why buyers want to buy assets is a tax reason. they get a step up in basis. So let's say you've depreciated your assets and the book value is less than the purchase price for the assets. The buyer gets to restart depreciation based on what the buyer paid for that. So there's a big tax benefit potentially. On the other hand, sometimes it's impossible to practically sell the assets, either because the business is dependent on a large number of contracts or contracts that are difficult to assign, or because there are governmental licenses, permits, and things that you can't assign as an asset. They have to go with the company itself. So sometimes sellers just insist that they want to sell a stock, and they're willing to take a slightly lower purchase price to achieve the capital gains tax treatment as well. But on the other hand, their indemnities are probably going to be more significant.
And that is something you want to work out in your early huddle with your advisors. Is what are we going to be allowed to do, and what is an absolute not going to be allowed to do.
Yeah, well said. Plan in advance so you know what you're offering. And Mike, let's change the subject to funding and to financing. How many businesses are people paying cash for, and how many are getting bank loans or financing? What are you seeing out there? What's typical today?
Banking is as tough right now as I think it's ever been in terms of borrowing. We see everything from a 90% cash at closing to one partner being paid out, the other partner providing some seller financing, and a bank coming in with money in addition to the company. It's all over the board. The harder your business is to sell, you may have to do more financing that's owner finance. Yeah.
Anything else to add on the panel to that? All right, let's jump to the cost. Everyone wants to know, hey, what is the cost to sell a business? So we got 4 high-powered people. It sounds like we need to have on the mission. So let's just, for now, concentrate on the M&A, on the actual selling the business. What are some sample price ranges that we might expect?
I think if you're dealing with a business broker who typically deals with businesses smaller than what we are talking about, in our firm, you're going to be paying around 10%. And that may be 10% of the contract price of the business. It may also be 10% plus a retainer. If you're dealing with the investment banking community, I would say that you're in the, I need to be careful I don't shoot myself in the foot, because you always remember the smaller number. But the smaller the transaction, the more likely you are to pay a retainer plus around 6%. Some days a portion of that retainer will be applied toward what we call the success fee. As you move upscale into transactions that are $20 million and higher, that percentage comes down. And every M&A firm can come up with a different way of quoting, but we all know that you're going to get down your calculator and say, what is this as it applies to the purchase or the selling price? So whether we do something called a Lehman formula, which is 5% on the first million, 4, 3, 2, 1, or a double Lehman, or a Daisy Duck. It does not matter. We know that you're going to figure it out, and we are going to figure it out, because we know what we've got to do to operate.
All right, I want to ask these gentlemen for some closing comments, and I want to open it up for questions. But before I do that, from, I can't get it from the video, so I got to get it from the members here, or the spectators here. Who has a question for us? They've answered everything. Oh.
I have franchisees, right? So they buy a franchise now. We're going into our 33rd or 4th year. We have folks now getting ready to retire to move on. Many of them have accumulated 5, 6, 7, 8 franchises. Trying to develop strategies with them to whether or not they're better off to put them all for sale at the same time, tier it out. Any thoughts to a better of those two?
Let me repeat the question for the video. So he's asking if you've got 6 stores, a franchisee has 6 stores, should you sell them together or separately, or does it depend?
I think it depends as much in my opening comments about who's the likely buyer. If there aren't many likely buyers to buy a package of 6 or 7, you probably want to do them in onesie-twosies. But if there are existing franchisees out there that would rather buy in bulk, I'd say then go in bulk, as long as it doesn't work against you in terms of who the likely buyers are.
More about putting them on the market. Are you better off putting them all on the market at the same time? And that's what I'm talking about, tiering them in. Like, so you start 5 years out and sell 2, sell 3, sell 1.
I think you're more likely to get what we would call a strategic buyer, somebody that is already in some type of multi-location distribution. You're able to get financing easier when you're selling 6. You get a wider variety of interest when you're selling a half dozen than the 1 and 2s. It's not unlike owning a half dozen McDonald's versus owning 1. The person that owns 6 has got a more marketable situation. They've got a spread of economic risk, geographic risk, market risk, all those things.
Yeah, and what we found when we're selling real estate like that is that the higher the volume of the price, the larger the price, the easier it is. There's economies of scale, there's more qualified buyers, and it's easier to sell 6 properties than 1. Now, one of the things that we'll do sometimes is put it out there and let people offer on the portfolio or offer on them individually, and then we make decisions based on the offers they come in. Is that ever done with businesses as well?
Yes.
Okay.
Yeah.
Okay. Question? Yes, sir.
Mike, you had talked earlier about given a choice between improving profitability and improving growth of sales, that a business owner should focus on growth of profitability. Given the fact that institutional investors and venture capitalists might, very often from what I've seen, will come in and invest money in order to grow sales at a hyper growth rate, ignoring profitability to start with to achieve certain high growth rate, to put them in position for gaining capital later, and then opting for improving internal financials later. What's your position on that?
And paraphrase the question as well for the video.
Well, the question is, how would we look upon someone who has taken an approach to use capital to grow their market, but not necessarily grow their profitability, if I'm paraphrasing what you said. At some point, the model has to change to get the profitability. And I think that's your risk in continuing to feed something that is using up funds. It's one thing if you have what I might call a lifestyle business and you don't mind staying at break even. But if you're a business that's going to have investors, at some point the investors want a return. And that's whether they're private or institutional investors or anything. They're going to want a return on that money, and they can't get a return on that money most times until there's profitability in sight and demonstrated. So that's why we say profit.
Well said. Another question?
With seller financing, what are some of the potential landmines for that seller?
What are some potential landmines for a seller of business holding financing? Who wants to tackle that?
Well, one of the hugest ones is that they don't make the revenue after you're gone to be able to make the payments. And that's, of course, the first thing that you think about. You want to make sure that you leave a business intact with great management so they will have the revenue flow and the profits to be able to make that payment to you. Understanding the fact that once you leave and you're selling, your salary and all of the benefits that you've been getting, all that money is going to be freed up for them to be able to help make those payments. But it's important that there's a good analysis of making sure that they'd be able to make those payments over the years.
Okay. I think one way that a seller can enhance their ability to realize on that financing is, and get paid, is to make sure that you take a security interest in assets sold, a pledge of stock if the stock is being sold. That needs to be carefully done, but that can be very important. Depending on who your buyer is, there may also be opportunity for corporate or personal guarantees to be given by the buyer or an affiliate of the buyer to back up the payments of that note.
And I think you also want to look at who is the buyer and how well they're going to be able to operate the business, right? Are they better than you at it? Then maybe you feel better, right?
Right.
Maybe they have some economies of scale, right?
Yeah.
Also try to keep it on a short fuse. A buyer may want 5 to 7 year terms on the seller financing. If I'm working with you as the seller, I'm going to be coaching you to let's figure out just how short the time frame is for repayment is what I mean by short the fuse is. And that way you're getting communication on a monthly or quarterly basis in the form of payment. And your risk is reducing monthly or quarterly by the amount that's being paid back.
Good tip, good tip. More questions? All right, can I get a final tip, one tip from each of you? Somebody's maybe they're preparing to sell their business, maybe they're ready to do it. What are some tips?
Well, I'll just mention that family-owned businesses have a completely different dynamic when it comes to which child is involved in the business, if there are a lot of children are involved in the business, and then the whole idea of, for example, if only one of the children are involved in the business and there's 2 others that are not, and it's a very profitable business, the whole idea of how do you equalize out their whole estate? Because we also know that business owners, usually their largest asset that they have is the business that they own. So if they're passing it all to one of these children, we need to find a way for us to funnel money to the other 2 to equalize out the estate so they treat everybody fairly.
Okay.
I would say that in any context where there are multiple owners, whether it's a family-owned business or whether it's a group of partners, a really good shareholder agreement done ahead of time can lay the groundwork for a much easier sale. You don't want small minority shareholders or family members who are not involved in running the business to be able to block a sale when the sale makes sense to those who are operating the business or to the majority owners. And you can address that ahead of time in a good shareholders agreement.
Good tip, Jeff.
I mean, a lot of what we've talked about, I think I can boil down to start the process early and be ready. You don't want there to be surprises. And if all of a sudden I decide today I want to retire on December 31st, I've already missed the mark if I say here in September, all right, it's time to get this thing ready to sell. You need to have plenty of runway out there.
Yeah, I think start early is great because I think it's a little bit like commercial real estate. When we're helping people buy commercial real estate, we're looking at the exit strategy when they acquire the property.
Right.
How are we setting up the entity? How are we setting the management? How are we setting up the capital to improve the property? How are we setting up the debt? So I think a business is even more so, right? You got to think in the beginning, hey, what is the exit strategy? Mike, final word?
Get a cadre of advisors around you. And that means your attorney, your wealth planner and manager, your CPA, and someone to represent you on this sell-side transaction. Get to know them, because there will be bumps in the road. And there just will be.
Great. Well said. We'll end on that. Gentlemen, thank you. Let's give them a hand. Good information.
Brought to you by Bull Realty, Asset and Occupancy Solutions. The Commercial Real Estate Show. An AKB Media Partners production. This video nor its participants are providing professional or fiduciary advice. For recommendations to professional providers, visit atlantaleadersgroup.com.